Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Crypto's premier institutional conference is returning to New York on March 18th to 20th. We're hosting one of the world's best crypto conferences for institutional and professionals alike. It's going to be a ton of fun. I'm going to be there hosting a variety of different panels. I'll be doing a fireside chat with Mohamed El-Arian, a different macro panel with Jim Bianco and Joseph Wang. And we're also going to be doing a live forward guidance roundup there where myself, Tyler, and Quinn will be chopping it up live for the guys Emporium. So make sure to get your tickets. It's going to sell out quick. I know it. It's going to be a ton of fun. So come on out and yeah, just hit the link in the show notes and you can go purchase your ticket today. All right, welcome back to another episode of Forward Guidance. And joining me today is Andreas Steno Larsen, who's a contributor at Real Vision and CIO of Steno Global Macro Fund. Andreas, you used to actually run a podcast on the Blockworks Networks here, so it's great to actually have you back on the other side and being interviewed. And I've been a long time listener of your work and your research, so it's really exciting for me to get you on the show. How are you doing?
Thanks so much for having me. I've been looking forward to this discussion. It seems like our views are kind of aligned, but let's see. I think it's a really, really interesting macro backdrop right now, and the sentiment is extremely bearish out there amidst what looks to be an upswing to me, which is kind of peculiar. So let's dig into that.
Yeah, it feels like there's a lot of points of tension in different dynamics. So yeah, you really got to get into the weeds of the macro world right now to really get past the surface headlines, especially because they are so Trump heavy to say the least right now. Yeah, so why don't we start with the liquidity backdrop? Because I know you've been doing a lot of really great work there and what you're seeing there. So, when we talk about liquidity, often a lot of different acronyms start getting thrown around and different charts of liquidity. So would love for you to just first off define how do you view, this idea of liquidity and how it impacts markets? And then what are some of the main top line drivers that you're seeing change at the moment in terms of your forecast?
Felix, first of all, yesterday, Jay Powell basically said that QE is not an option as long as interest rates are not zero. And, that headline made the rounds across X, various media outlets, etc. But it's not really a surprise, is it? QE has always been a tool used when the zero lower bound was hit in interest rates. So it's nothing new. It's the same view as the Fed has always had. And we can get liquidity additions anyway. And that's important to underscore that point because QE is just one form of liquidity. There are various forms of liquidity, some of them created by the public sector, some of them created by the Federal Reserve itself, and some forms of liquidity stem from the private sector. If you look at the liquidity developments, say over the past 18 months or so, we've actually had a pretty benign overall liquidity environment because of the private sector liquidity developments, not because of the public sector liquidity developments necessarily, and certainly not because of the liquidity developments from the Federal Reserve. So let's try and, deduct the importance of these three agents in terms of creating liquidity. First of all, obviously, the Federal Reserve is in charge of creating the base layer of money. So they can do so by adding to liquidity via QE. They can add liquidity via all sorts of technical programs, such as the overnight reverse repo facility. That facility has been mentioned a lot. It's almost been the highlight of liquidity analysis for a while. But in any case, the Federal Reserve is just one out of three agents in this space. If you look at the Treasury, the public sector, they can create dollars as well by running a fiscal deficit. They can add liquidity by running down their liquidity holdings at the Federal Reserve, the so-called Treasury General Account. That's probably what we're going to see over the next 6 to 8 weeks, by the way. And they obviously impact liquidity on a running basis, both via their issuance decisions, but also via their budget decisions. And then finally, on top of this public layer of liquidity and money, we have the private banking system. And the so-called money multiplier is basically a measure of how many dollars the private banking system creates on top of the base layer of public liquidity. And that's been the driving force of liquidity over the past 18 months. We've actually seen a decent increase in the private credit creation, especially over the past, say, 9 months or so. And to me, that is the most important part of the liquidity cycle right now, because we're not going to get QE anytime soon. Powell basically told us that. But on the other hand, we're starting to see signs of a severe pickup, a very, very solid pickup in the demand for credit in the private banking system. We also saw how small and medium-sized companies said this week that credit conditions ease now. The availability of credit is actually better than it's been for a while, meaning that we should probably expect them to take up some more loans, right? And when you get a loan as an SME, you ultimately create a deposit in the banking system, and that's liquidity. So, even with QE not being around the corner, I actually think it's a feasible scenario that liquidity will do absolutely okay this year, and it will likely even increase a lot because of the private banking system.
Yeah, maybe just to prove out this idea, you could address this notion that I've seen where it's, somebody will look at, okay, we've had a couple of years of quantitative tightening now. We've had one of the fastest increases in the Fed funds rate, one of the fastest hiking cycles we've ever seen. Oh, financial conditions are as tight as they can really get. And despite that, we've still seen equities at all-time high. We've still seen crypto doing really, really well. But it sounds like as you're mentioning these different dynamics, there's nuance there involved. So would you characterize as liquidity dynamics as actually being tight? And if not, could you just explain, like, how have we gone through the last couple of years where we've just seen all-time highs being hit all the time? What are some of those offsetting dynamics compared to some of the top line indicators like quantitative tightening, when people refer to that? Why is it that even though these have been occurring, we've seen strength in liquidity and strength in risk assets to pair with it?
If we look at liquidity in a very narrow definition, I'd say that liquidity is relatively tight. So if you look at central bank reserves and the amount of liquidity that is available for banks with an account at the Federal Reserve, that liquidity measure is tight. And we're starting to see the signs of that every quarter and year turn, where we have spikes in money market rates, etc. But if you look at the private sector liquidity, we see a pretty abundant liquidity picture on the other hand, because of an acceleration of the private credit creation, because of an acceleration of the money multiplier. So basically, private banks create money on this base layer of bank reserves from the Federal Reserve to a larger extent than what they did 2 years ago. And that is the relevant measure to look at right now, because it basically explains why we've seen all-time highs in equity markets over the past couple of years. It explains why we've seen a very positive development in crypto over the course of the autumn, since we had almost an explosion in the broader money supply due to the private money creation. And I tend to look at measures like M2 and M3 and try and deduct what's driven by the Federal Reserve and what's driven by the private system. And if you look at the private money creation over the past couple of years, it's basically through the roof, while we've seen QT from the Federal Reserve. So I think that's kind of a surprise to many, but it's also a testimony to the fact that private banks can actually create liquidity and can create money out of thin air, even if the Federal Reserve is trying to tighten liquidity conditions. And on top of that, we've obviously seen a whole range of liquidity tricks from the Federal Reserve to try and, contain the downside pressure in the very narrow liquidity measures. So basically, since 23, we've seen the Federal Reserve using both this overnight reverse repo facility. We also saw liquidity additions around the Silicon Valley Bank failure in this bank term funding program, BTFP, which was basically QE, not QE. And, they've used a bunch of tricks to ensure that the amount of dollar reserves in the financial system did not breach the lower pain threshold. And I think we're relatively close to that pain threshold right now, but they're safeguarding that level very fiercely, and we've also seen that in both the minutes, but also in some of the speeches from the members of the committee, that that they are aware that we are not too far away from some sort of pain level in the official / narrow liquidity measure.
So I want to hone in on what feels like the next trick that is likely coming up, and you have this chart here of the TGA. So to your point, reverse repo, as quantitative tightening has been occurring, it's been largely offset by the high balances that were in the reverse repo. We're now sub $100 billion there, so that is largely tapped out, and so now we're shifting towards looking at what is the next trick that is on the horizon. And just to contextualize the situation here is that we've reached the debt ceiling, and what happens there is, first off, there's this sequence of extraordinary measures, which I'd love for you to explain. What does that actually mean? Because, and under my understanding, nothing about it is actually extraordinary. They do this every time we get to the debt ceiling. And then what is the sequence that comes next here, and why is it relevant for the TGA account, which is what we have here in this chart?
As soon as the debt ceiling is in place, the Treasury will have to use so-called extraordinary measures to fund itself. And as long as they use these extraordinary measures, they can actually issue still. So as of today, they've probably exhausted around 65 to 70% of these extraordinary measures. And we're talking measures that are pretty normal, as you say, because they're using pockets of liquidity available in the Treasury system. And they have various measures that they can take into use every single time. But of course, there's an end date on these measures, and we're approaching that end date quite soon. It basically means that the final funding source left for the Treasury is the Treasury General Account, an account they hold at the Federal Reserves, and it's basically a war chest. It's idle liquidity designed to be there in case of emergency. So the larger the debt, the larger this war chest of liquidity at the Federal Reserve. They've been constantly raising the bar for this Treasury General Account over the past 5-6 years, in conjunction with debt levels being higher and higher. But ultimately, this pool of liquidity is there should it be needed, for example, because of the debt ceiling. That's basically not the intended design. But in other use cases, you could, for example, mention in times of extreme stress in Treasury markets, they can use this facility instead of issuing and allow the market to calm down before issuing again. We've seen that, for example, during the early stress in March 2020. So they have almost 800 billion parked there, and they'll spend that during late February and March. And when they spend those dollars, private banks will be on the receiving end of the deposits. So it basically means that private banks will receive dollars, and it will put a downward pressure on short-term interest rates. It will likely lead to slightly larger risk taking in the banking system, and it's on the margin decently good news. But I'd also like to stress that this is probably the least efficient liquidity addition of all of the liquidity measures that we've mentioned. First of all, when you add liquidity via the Treasury General Account, you know that it's a temporary liquidity addition, because ultimately, if the debt ceiling is raised again, they'll replenish this liquidity pool, right? They'll issue again, and then they'll put it on that account in the Fed system. So we know that it's temporary. We also know that the typical issuance pattern from the US Treasury, once we get to the point where the TGA is in play, is to bring down the amount of T-bills outstanding. And therefore, this liquidity addition does not help private markets absorb duration. If they bring down the amount of T-notes or T-bonds and instead use the TGA, then there's obviously some positive duration effects as well. But in contrast to, for example, outright QE, where the Federal Reserve buys a long-term bond, this liquidity addition does not facilitate a duration absorption to the same extent as QE. So it's okay on the margin. It's positive, but it's the least efficient form of liquidity additions.
Yeah, I've always sort of felt like, we know that markets are forward looking, and this specific rundown here, regardless of what, like, yes, the TGA will go down to zero, but we know that once the debt ceiling gets resolved, they're going to have to build it right back up. And so, not only that, is that the last time that they did this, there was a lot of buffer in the reverse repo. So, Yellen can come out swinging and issue a shit ton of bills, and they could be absorbed by the reverse repo. That's not really the case this time. So, you know, I don't know if you've looked into this much, but like, yeah, shouldn't markets just look at this and say, "Oh, it's just temporary. We're gonna look past it, and we're gonna look past it to the point where, oh crap, when we get onto the other side of this, where are these bills going to come from this time? The reverse repo sub 100 billion, right? So then it's like, okay, well, where does this come from next?
Yeah, I think you're spot on. First of all, there's obviously an interlink between the Treasury General Account and this overnight reverse repo facility, because if they decide to bring down the amount outstanding of T-bills this time around, we'll likely see a small spike in the overnight reverse repo facility as the TJ moves towards the zero lower bound. And therefore, there's sort of an offsetting effect liquidity-wise from the two programs moving in the opposite directions. On top of that, it is temporary by nature when the TGA is put into use. And therefore, the medium-term signal value of adding liquidity via this measure is not particularly strong. It's absolutely non-existent. And therefore, as I said, this is the least efficient form of liquidity additions. And you could even argue that you shouldn't care.
Yeah.
But there's a certain dynamic every time liquidity is added to the system, because a bank treasurer will typically look at a liquidity window of plus 30 days due to legislative designs. And if the assessment is that the TGA will run close to zero for more than 30 days, there is a positive impact on interest rates, meaning that interest rates will come down, but it's marginal.
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee-free transactions. Whether it's gaming, AI, or next-gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. To your point, Powell said that no QE until, rates would have to be at zero. And for rates to be at zero, like, nobody who's long assets wants that to happen, because that's just spelling a terrible time in the interim. How do we durably get to the other side of this? Obviously, once this occurs, it would make sense that sometime in the spring we see quantitative tightening, and that's probably the step that comes after that. But then what happens after that? It sounds like we need some sort of durable increase of liquidity, and it seems like we're getting to the point. Maybe I don't know if you saw this speech from Bowman this week, talking about starting to come up with this SLR exemption type idea, which would allow this further marginal bid of bonds. But it feels like more and more there's less and less levers to be able to get pulled here.
They'll need to find a very creative way of adding liquidity this time around, because QE smells bad when inflation is above target. It smells bad when interest rates are not zero, and therefore they cannot do QE, and they will not do QE. But they can do QE, not QE setups. One idea that I've seen floated as well is that they'll basically ask private banks to use the discount window on a running basis. So remember, the discount window is typically a borrowing window that is put into use during times of stress. For example, just after the Silicon Valley Bank failure, banks took out loans from the discount window, and that added liquidity to the banking system. But if you ask banks to use the discount window on a running basis, basically force them to via some sort of legislative change, you actually get a liquidity addition, and at the same time you get a bid for bonds, because banks will have to post, for example, treasuries at the discount window to get a loan in return. So I think that's one of the options on the table. The other one is the SLR exemption that you mentioned. So we're talking things that are very far from QE,
Yeah.
but ultimately the effect is almost similar, but there are differences in terms of how much duration they absorb. And they'll come up with some sort of officialese way of adding liquidity, if you know what I mean. They'll not call it QE. They'll try to avoid discussing it too much in public, and they'll just say that it's technical in nature. See how Bank of Canada communicated the restart of some sort of light QE. They just say, okay, we need to expand the balance sheet in a measured way that compares to the GDP development going forward. You could argue that GDP developments have been net negative in Canada, so they will ultimately end up doing QT anyway. But joking aside, that's one option as well, right? Saying we'll buy bonds to an extent that matches the growth of the economy.
Yeah, it feels like overall, like the biggest losing trade is thinking that the Fed is cornered and that they can't kick that can down the road. There's always a way to kick that can, and
Yeah.
they'll make sure of it. I want to shift gears a little bit more towards private credit. You mentioned how credit activity is starting to come back here, and I just want to set the context here of something that I've been thinking about, which is that, okay, you look over the last couple of years and we've had pretty robust GDP growth. We have risk assets at all-time highs all the time. You would think that, credit is surging right now, but it actually, and we can also tie in the manufacturing sector and what we're seeing there, but it feels like the core components of the economy actually haven't been as robust as it might seem from the top line here. So, when you look at something like commercial credit here in this chart, you can see that it feels like it's only just starting to get going. So I'm curious if you could just unpack that idea and further hone in on, like, why is it that we're only starting to see this uptake now? Is it just where we're at in the business cycle, or what do you think was stopping this from really getting going until right now?
So first of all, I think this is a lagged response to the cuts we saw last year, the easing of financial conditions via lower long bond yields into the summer and all that. It roughly takes 12 months before we're starting to really see the credit pickup after such a move in bond yields. So on the margin, there's a lagged response to the monetary policy from last year. But on top of that, I also think this is a response to the public sector withdrawing from the credit market. And let me add some color to that, because through 23 and to some extent also 2024, Joe Biden was the bank in the US. Some of the measures that he implemented, not least the Inflation Reduction Act, is one big credit scheme. It's tax credits if you do X, Y, Z, right? So we've seen a massive credit creation from the public sector through that period. And obviously, if the public sector competes with the private sector on providing credit to everything related to data centers, raw materials, such projects, we'll see a pretty lackluster development in private credit. So I actually think this is, a mix of a lagged response to monetary policy and a symptom of the public sector actually withdrawing from the credit market.
Interesting. And then on that note, like, do you agree with the premise that fiscal expenditure, like you just pointed out too, has floated us through the last couple of years, and without it, we would have actually, there's a lot of talk for recession in 2022 and that occurring. Do you feel like, yeah, we've been floated through that, and now we're on to the other side, and we're starting to see the uptick, and that might be a good segue into discussing like how you're looking at PMIs in the manufacturing sector, because those actually have been they've been sub 50, which is a contraction, and we're only just starting to see those pick up. So do you agree with that premise that we've actually just been floated through from fiscal, and now we're starting to see the fundamental upswing from there?
I think it's very fair. And if you look at the forward-looking indicators from manufacturing, I would be surprised to see the manufacturing PMIs above 60 this summer. I think it will be a very, very fast move from here. We're starting to see the first signs of a pickup in new orders. We've seen some of the regional PMIs through the roof, for example, the Philly Fed. The last ISM report was also pretty decent, especially when you gauge the forward-looking components of it. So sure, we are starting to see a pickup in the manufacturing cycle, but it's very early days. And I think that's why we are stuck with such a gloomy sentiment, especially in crypto. I know that everything outside of Bitcoin is not doing well at the moment. But anyway, we've seen pretty solid returns 12, 18 months in a row. And yeah, everyone I talk to, they sound like they're living their last day, right?
People seem
it's very
lost.
weird. Yeah, it's very weird. But I think it's due to the manufacturing cycle not picking up speed. But we're actually very close to seeing that in practice now. When it comes to fiscal, I don't think there's any doubt that Joe Biden postponed the crisis and basically saved the U.S. economy from cratering via the Inflation Reduction Act, via the Chips and Science Act, and ultimately the headache after the pandemic had to be absorbed one way or the other, either via inflation or via recession, and they chose the inflation path.
Yeah, I mean, I guess what's also confusing is, okay, and it sounds like we both agree on this, is that, we're actually more early cycle than late cycle, and the credit cycle is only just getting going, but we're going into that point with valuations quite stretched. So my question to you is, how do you contextualize that with what we're seeing in terms of equity valuation? Because I feel like that's maybe the part that's freaking people out and not getting fully on board with this idea of being early cycle.
Of course, when you look at multiples from Tesla and the likes, it seems like we're very late cycle, right? But I'm also of the view that we keep underestimating the value of these Max 7s. And let me try and explain why. Because, the concentration of power among these 7 companies has never been more immense than right now. We even have a couple of them in government, right? And if you look at the client base of Meta, to take one example, Meta has been on a tear basically over the past 14 days. Is it possible that every single person on Earth ends up being a client of Meta? Yes, that's very possible. That was not the case in 2000 when you saw similar valuations. It was not a feasible scenario to expect some of these players to have every single person on Earth as clients. I think that's a feasible scenario for Meta. Of course, I'm exaggerating this, but the concentration of power is extreme relative to what we've seen at any point in history. So Buffett indicators, all of that boomer shit, throw it in the garbage can. It's not designed for this era. It's not.
That makes a lot of sense to me. Definitely agree. I mean, you start to look like the last month, you can see is like, NASDAQ has been ranging, but it feels like the breadth has actually been improving. So, you look at something like the Russell and the companies there, that actually starts to align more closely with where we're at with the business cycle. Do you agree with that aspect?
Yeah. Russell is a special case because it's so sensitive to inflation and bond yields, and maybe especially wage growth, actually. So, it was a bit of a setback for Russell, this relatively hot wage growth report we saw alongside the non-farm payrolls. But I'm actually pretty upbeat on the cocktail ahead for the Russell index because wage growth is coming down. We have very solid, say 2 to 3 quarter leading indicators on wage growth. For example, the quits rate from the JOLTS report, it leads wage growth by 9 months roughly, and its wage growth is going lower. The flip side of that is obviously that the real spending power likely goes slightly lower as well. And typically I'd argue that the manufacturing cycle is the best gauge of the investment environment. I'm a little less certain this time around because we enter this cyclical upswing with a slightly odd cocktail of high multiples, higher bond deals than usually going into such a cycle. I would argue, and I suppose you agree, Felix, that when we enter such a cyclical upswing, it's actually a good bet to bet on higher long bond yields. That would at least be the typical pattern. It's a little bit less certain this time around as well, since we have these very lagged effects on wage growth, and the service sector seems to be responding slower than usual to rate hikes. So, the cycle is not normal. I think that's fair to say as well.
Yeah. I think what might be helpful here is to take this context we just outlined and apply it to inflation and CPI print that is coming out this week, and PPI as well, because I feel like that's where there's some more confusion and uniqueness that's going on, because just to set the context of how I'm viewing CPI these days, is we've seen significant disinflation from the goods sector, that it's aligned pretty closely with this stagnant manufacturing situation that we just described. So that's come down, and that's been all great. We've even seen a couple months of outright deflation from goods. At the same time, on the services side of things, and especially looking at like shelter and lag, OER and those dynamics, that's kept us sticky and above the target. So I would love to just hear about how you're thinking about CPI and inflation as it stands today, because if we're talking about being early in a business cycle here, obviously that's going to have a positive effect on inflation in terms of like goods, and especially things like food. But at the same time, I'm of the belief that shelter will continue to come lower. So I'd love to just hear about how you're thinking about all of that as it stands.
It's kind of the same story as we just discussed on growth, right? Because we have this intersection between services and manufacturing, and it's very unusual that they move in almost in opposite directions. But that's basically what we're seeing right now. Service activity slightly down, leading service prices slightly down along with it, while we're starting to see that pickup in manufacturing, slowly but surely spilling over to higher food prices, higher energy prices, potentially higher car prices, stuff like that, through the first half of the year. So if you look at inflation solely in what you could label the necessity basket, it will likely look terrible in 25. But measured inflation, including shelter, including insurance costs, some of those extremely sticky categories, will look very benign because of the way that the inflation is measured in the US. And let me stress that, because if you look at the European calculation, or basically the way the inflation index is calculated right about everywhere outside of the US, there's a much larger weight on goods, and there's a much smaller weight on housing. So I think inflation will look pretty nasty where I live in Europe. It will look pretty nasty in many countries with a large manufacturing footprint. Sweden, to take a very good example, Korea, some of those very industrialized nations with a big component in manufacturing in their sort of economic basket, while the US inflation basket will look benign relative to the rest of the world. And to me, that's a pretty solid story for the local dollar market. It's not a good story for the dollar versus other currencies, but that's a story for later. But the Federal Reserve will likely be the central bank with the best opportunities to keep an easing bias intact through the year. Maybe even that they'll even keep easing through a pivot from the European Central Bank, Bank of Canada, you name it. And that's because of the design of the inflation basket.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow the journey on X at Scale Network. That's really interesting. Yeah, so I was going to ask, it sounds like, despite, the necessity basket probably heading higher for the US, there's still going to be an opening for cuts to continue from the Fed. But what's really interesting that you say there is that at the same time, it feels like it's less likely for those other markets like Europe. Would you pair that with what we're also seeing, and this might be a good time to bring up the tariff situation, how that's impacting other economies, because there's a lot baked into the dollar right now where it stands, both in terms of just this outright economic strength and lack of cuts from the US versus weak growth in other countries and more cuts occurring. It feels like what you're saying is that that's about to reverse, at the same time that there's a lot of what I would call like tariff premium baked into the dollar right now and US yields. So when you combine those together, what are you seeing? And also, like, what is your overall tariff outlook in terms of what's actually happening?
So I guess first of all, Felix, I remember you and I had a discussion on the dollar and bond yields just after New Year's, and it felt like a huge premium was baked in already then, and I think ultimately that viewpoint proved to be the right viewpoint. I think both of us managed to throw in the towel right at the at the wrong timing, right? But
Yeah.
anyway, I'm still leading that way. That the dollar needs to weaken from here. That dollar bond yields will come down uh, alongside a fading tariff premium, alongside slightly lower services prices, and all of that. But looking at the tariff situation right now, I kind of have the contrarian take that the reciprocal tariffs put forward last Friday by Trump, um, that concept could actually end up with a race to the bottom for tariffs globally. Because if his message to the rest of the world is that we'll match your tariffs, no matter how high they are, we'll likely see countries like China, India, Brazil, big EM countries end up having second thoughts around whether it's smart to have such high tariffs. It's not really a big issue for the Eurozone, for the UK. Most G10 countries do not have high tariffs versus the US, but a lot of EMs have. And they will have second thoughts if he decides to go for this tit for tat approach. And therefore, I think this is the exact reason why we're seeing Europe performing as well as it is right now. Europe has been the best performing equity market more or less on earth since
This
this
is
whole
crazy because I
tariff.
feel like nobody's talking about that.
Yeah, and
Like, yeah.
I think the reason, Felix, is that it's been a widowmaker trade to suggest to go long Europe for a decade, more or less, right? And this is my favorite chart right now. My colleague Rahul Pal and I, we've toured with this chart on the European banking system being stuck at the abyss, and now all of a sudden the European banking index has broken out and it's on an absolute tear right now. It's the best performing sector on earth, basically 6 weeks in a row, something like that. And to me, that's the ultimate sign that Europe is actually moving out of a very bad spot. And um, fair enough if you want to accuse me of having a home bias here, but it's not. I haven't toured with this story for a long, long, long while, but I'm pretty upbeat on Europe right now, especially because of, I think you showed the chart on the relative change of goods exports since the pandemic. This one, as you can see, the Eurozone has lost market shares basically since 2020 on a trend basis to China, to LATAM, India, you name it, even to the US. The reciprocal tariffs concept is potentially a sweet spot for the Eurozone, since if you go for the tit for tat approach, you actually can add a whole lot of tariffs on the Eurozone because the average tariff is lower in the Eurozone than it is in the US, according to the World Bank database on the topic. So it's a much bigger issue for Modi in India. It's a much bigger issue for Lula in Brazil than it is for the Eurozone. And yeah, finally, some good news for Christine Lagarde and her ilk.
I mean, yeah, this is so interesting because you look at the headlines and you would just my assumption is okay, well, like, yeah, places like Europe, or I'm in Canada, and we're just getting the brunt of it right now from in terms of tariffs and Trump, and so it's like, oh, these places are screwed, but and yet, like you just showed, this could actually be, it has been a widowmaker trade for sure, but it does seem like this time might actually be different, which is quite shocking. And I just want to, confirm this and make this clear for the viewers. But this idea of reciprocal tariffs, like, this is different from what's been talked about in the lead up to the election, right? Like, and how do you square that with this idea of the talk about how we need to instill significant tariffs to replace income taxes and increase revenues and bring the deficit lower? Are they just softly changing the narrative and almost giving up on those ideas, or what do you think of that?
I guess it depends on the response they get from some of these big emerging markets, because ultimately, if India starts bringing its import tariffs down, if Brazil does the same, and you've told them that the tariff approach is reciprocal, then you have to lower them again, right? I'm not sure that Trump will give any like promises in relation to that. But in any case, the concept is tit for tat, right? If they lower them, you lower them, right? So I think it doesn't square particularly well with this whole notion that you can use tariffs to replenish the coffers of the U.S. Treasury. I basically think that this whole idea is bullshit, if I may, because you'll have to increase tariffs to an extent that is abnormous if you want to square the deficit via the tariffs channel. So I don't think it's a feasible path ultimately, but it sounds good because it sounds like someone else is paying for it, which is obviously not really the truth by the end of the day. So my take is basically that Trump is surrounded by businessmen heavily invested in global supply chains. And behind closed doors, they'll tell him not to go too far on this agenda. I think that's my base case for now. Who's able to forecast Donald Trump? I'll not claim that I am, but my best guess is that the administration that he's put together this time around is a lot more anti-tariffs than the one he had last time around, but behind closed doors at least.
It's interesting when you start to really get into the weeds like we have on this show so far. It seems like there's a lot of things to be optimistic about, but then to your point, there's actually been a lot of pessimism, and there's been a lot of obsession with whatever Trump is saying, or whatever executive order is being signed on that given day, and that's really taken hold of the market narrative these days, and it's led to we haven't seen an outright pullback, but we've seen a lot of range bound assets. So I want to ask you about how do you translate this idea that when you look into the fundamentals, things are actually getting quite good. It's just these large loud headlines that are taking over the narrative. How do you translate that into your market asset outlook for equities, bonds, global commodities? I know you've been looking into the gold situation as well. Would love to hear that.
Yeah. Take a look at the inventory cycle of metals at COMEX in the US. It's absolutely bizarre to see those inventory numbers over
this chart here.
For example, this one on gold. You could have picked platinum, copper, you name it. Every single metal is being moved to the US in size and with a tremendous speed. And I guess this is all related to tariffs front running, right? Because if you're a wealthy guy living in Boston or New York, I think prior to this tariffs chatter, you wouldn't mind having your gold bars in a cellar somewhere in Switzerland or in London or in Luxembourg or in Andorra or whatever. But now with tariffs, it makes sense to ship them to the US before those tariffs are implemented. And for now, we don't have tariffs on gold imports, but I struggle to explain it in any other way. It's just massive. And we haven't seen anything like it since the pandemic, where all of us thought that we had to buy canned food and gold to survive, right? So it's a very, very peculiar situation. And, in my fund, we've been trading gold on the long side all year. And, I'm tempted to say that it looks very, very topish now. But then again, it seems like everyone is front running this tariff era.
Yeah, specific to gold, do you think this recent price action has just been something to do idiosyncratic with this? Because it feels like, if you look at it from like a real rates valuation or something like that, pretty much any traditional gold valuation metric is like, okay, we're pretty stretched here, and we just keep surging higher. So you think it's something like idiosyncratic like this, or?
I mean, we've run a few fundamental models on gold, for example, using the real interest rates in the US. We also have a global real interest rate model for gold, and the R square is 0 right now. It does not explain anything. So something very idiosyncratic is going on in gold. And I think this most recent surge in the gold price has been primarily driven by Westerners, which is a game changer relative to what we saw through the first 3 quarters of last year, where these buying spree was driven by Chinese high net worth individuals, Indian high net worth individuals, as some sort of hedge against the strong dollar. So we've been seeing central banks involved in this trade as well, but they're not driving it right now. The driving force is this material front running of tariffs. And, you know, I went to the US last week. I know it's common to see like gold and silver commercials every 30 seconds when you drive around town in a taxi, but it was it was bizarre this time around. It was all I saw riding taxis. Only gold and silver commercials airing. So I think, and they all use this excuse: bring it to the U.S. now, buy now, because of blah blah blah. Right. So I think it's a very idiosyncratic story, and it will end in tears at some point. But I'm not ready to call the top yet.
Do you think any of it has to do with, like fiscal concerns or Trump doing whatever Trump's doing? And, I could see somebody look at some of the headlines and then look what's going on gold. And it's like, oh, we're all terrified of owning US bonds right now. And the US dollar hegemony is ending or something like that.
Yeah, I think there's some merit to that story, but it's certainly not the full picture. And if you look at the actual developments in the U.S. fiscal deficit since Trump's inauguration date, we've actually seen a pretty sizable contraction of the deficit. So Doge is working. They'll not be able to find all of the needed dollars to balance the budget, but they'll certainly bring it in the right direction. And the momentum seen in this Doge project over the past 2 weeks has just been incredible. You can talk about the moral aspects of it and all of that, but it's certainly an efficient move. And for now, I'd rather, I'm a European, right? And I would love to see something like that in Germany, in France. It would be even more necessary there. And we're starting to see some momentum behind that idea even here now.
On that note, if we're in a regime where it feels like a lot of risk assets have been floated through from fiscal expenditure, and then we remove the fiscal expenditure, does that cause any concern on risk assets for you?
To some extent, but I think there will be a slight rotation because of this move from fiscal spending to more private spending. And I think that rotation is best described from it's a rotation from a data center economy to a real life economy, basically. And that's what we're starting to see now. Stuff like materials will likely have a very, very strong 2025. Banks, banks will thrive in this environment with a skyrocketing private credit creation. Donald Trump not even just removing regulation, just firing all people in charge of regulating the banking sector, right? It's going to be the Wild West, meant in a positive way, in the banking system again. I grew up in the banking system right around 06, 07, 08. And to some extent, we're starting to see some of the very early vibes I had back in 06, 05. Far from the actual crisis moment, the point where everyone's just like, yeah, let's take up a loan and buy stuff, right? That's the kind of vibe I'm starting to get now.
I just want to end with just getting clarity on the bond situation, because to your point, that it's a difficult one, because if you just take the framework that we articulated earlier about where we're at in terms of credit creation in the business cycle, yeah, you'd expect bond yields to go higher. But then you have the Doge thing, which is saying that, if we get a lower deficit, that could also, decrease bond yields. Yeah, it feels like there's a lot of different factors. So, is it just something that you just want to set aside and not look at, or do you want to take a directional view on it?
I have my eyes glued to a chart that I also sent you before this, Felix, on the so-called Truflation measure and long-term bond yields. The Truflation measure has been, debated among macro pundits basically a handful of years in a row, more or less. And some of my good colleagues, for example, Darius Dale, find it unlikely that they're able to measure inflation in a better way than the BLS. But I actually think there's some merit to the idea of measuring inflation through the month ahead of the actual inflation releases. And as you can see from the dark blue line here, the Truflation measure is basically on the floor. We're basically back to levels seen in September, October, where the 10-year traded sub 4%, right? So, I have a very, very high conviction in long bond yields coming down now. But I'll allow those words to be my famous last words for this show, because I've said so a couple of months in a row now. And, I'm finally getting some traction on it. But, the beginning of that trade wasn't pretty.
It's been a hard one to nail, to say the least, to be bullish on bonds. So I'll give you that it's not an easy one to have. I'm curious on this Truflation print. Do you know what was the driver of it? What brought it so much lower? Was it like goods or?
Yeah, and actually utility costs. And that surprised me a lot, because I was actually of the view that utility costs were going to increase this year. So there's something going on in relation to these typical January effects. A lot of people expect the January report on inflation to be super hot because of these annual increases in utility costs, the reweighting of the index, putting even more emphasis on services, for example. But I'm not sure, watching this very timely data from Truflation. We, by the way, try and run similar online observations ourselves in the fund, and we get kind of the same conclusion, not as firm, but the trend is exactly the same as what we see here. And the whole Q1 effect of higher prices, we've seen that in 2021, 2022, 2023, 2024. I don't think we'll see it this year.
Andreas, it was great to finally get you on the show. Been a long time fan of yours, and you have some really great charts, as we just showed through here. Where can folks go if they want to see more of what you do and what you talk about?
So I run Steno Global Macro hedge fund, and then I'm a contributor at Real Vision. You can find our Macro Monday show on Real Vision and on YouTube.
Sweet. Awesome. Well, thanks for joining us. Really appreciate it.
Thanks very much.